Hello everyone, welcome to a product review at Phenomenal. Today we are going to look at arbitrage funds. What's so magical about arbitrage funds? When you get into this category, it feels like it's free money, but when you look at the returns and also how it's behaving in terms of returns and risk wise, you would come to know that this is kind of similar to what we already have, which are liquid funds or like overnight funds in the debt fund category. So arbitrage funds, if you've not never heard of arbitrage funds, so these are instruments. You buy the, let's say, any equity or like any equity stock or anything in the cash or like this the spot market, that is the stock market. You buy it for, let's say, 100 rupees, and you buy the same instrument in the futures market for, let's say, 105 rupees in the futures market, and you profit out of this small difference. So when you look at all these arbitrage funds, this is what the underlying security, the underlying holdings itself is equity. It's not like any sort of like bonds or anything, right? So to start off with, let's first compare top five arbitrage funds in the arbitrage category. You will find some sort of like a resemblance to liquid funds. Then we will compare these funds to the liquid fund category itself, and quite within few seconds you will understand that there's no magic to arbitrage funds. There are also use cases. Don't get me wrong. There are use cases for arbitrage funds, which I will at the end of the video tell you which kind of customers or which kinds of investors suits or like to should go with arbitrage funds instead of liquid funds. So when you simply look at the performance of like the top five arbitrage funds itself, you can see like a steady flow of income, right? So when you're used to seeing a lot of performance graphs, you can quickly identify that, oh, this seems like a bond fund, but although the returns are similar to a liquid fund, which I will quickly compare, this is considered as an equity fund because the underlying security itself, these are like futures and like basically these are like equity market instruments, but we don't like the arbitrage fund itself doesn't like it might hold some of it, like some portion of it in the bonds and like other like cash category, but the underlying most like majority, like let's say 70-80% will be in the equity markets category. And also there are tax advantages to it, right? Like equity funds itself incur like less taxation than like debt funds, so which we will get into it at the end, right, end of the video. So we've looked at the performance here, and when you look at, let's say, the CAGR, like annual returns itself, it's hovering around like 7%, right? And the volatility is on the lower side, around 1%, right? For when you look at this fund as like as a newbie, right? It looks awesome when you think in terms of like equities, right? Like 1% volatility, but when you compare this to, let's say, a liquid fund, right, which we will do now. So for example, like let me take the SBI Arbitrage Opportunities Fund. uh, I'll just go with SBI just to be in the same AMC, right? So I will compare this to SBI Liquid Fund. I will also take a short-term bond fund, and I will also take an overnight fund. So these are all like comes under the debt category, right? Like debt mutual funds category. All right. So what do we see here? So the fund, that is the blue line, is our target fund, right? Which is the arbitrage fund. We can see it's here, and right, some which is similar, exactly, pretty much similar, is the SBI liquid fund. So you might think like, okay, what's the difference here, right? Like the main difference is SBI arbitrage fund is considered from a taxation and also from a classification point of view. It's an equity fund because the underlying holdings are equities, whereas SBI liquid fund, the underlying holdings are like debt instruments, right? Like these are like government bonds or that bond related instruments. These are the underlying instruments in the liquid fund, like that is the SBI liquid fund category, right? And similar to it, like overnight funds, like these are like similar, like not exactly similar to liquid funds with varying maturities, right? So you can see it's kind of lower than liquid and arbitrage fund. And short-term bond funds again, the all these three bond funds, like the debt funds that I picked, right? These are all like debt funds, but with varying maturities, right? Like the SBI short term, that is this the green line, right? So it might have a maturity of like 6 months, 1 year, 1 year to 3 years, right? And when you look at like performance wise, it's clear, right? Like liquid funds and arbitrage funds, they are pretty much the same. Now comes the question: why are they same? Right? This is an equity fund, whereas with the arbitrage fund is an equity fund, whereas the liquid fund, that is a SBI liquid fund, is a bond fund. Why are the returns same? So now this kind of goes a bit complicated, but I will try to simplify it, which is both these instruments are linked to interest rates. The SBI liquid fund is directly linked to the interest rate, whereas the SBI arbitrage fund, all arbitrage funds in general, all arbitrage funds are indirectly linked to interest rates. So basically, the interest rates are used to price the futures contract itself, right? So both of them are linked to interest rate. So that's where the connection comes from. Although the underlying instruments are different, the main link is the interest rates itself, right? Let's quickly look into the volatility of it itself, right? Since all these four funds are bought, not for like capital appreciation. This is for capital protection or the capital preservation, right? So these are like low volatile funds, not like similar to equity funds, right? Although arbitrage funds have equities in it, it behaves like a liquid fund because of the arbitrage concept itself, right? So if you look at the underlying fees itself, right, the overnight fund, it's the lowest, but also the return in terms of like, see, the holding period itself is like all these four funds. If you look at just these three funds, right, like these three debt funds, these are all of varying maturities and also for different purposes, right? Like if you just want to hold it for a week, 1 day to a few weeks, right? You can consider overnight funds, or short-term bond funds are like completely different, right? So if you want to have exposure to bond funds, and you're thinking of holding it for like a year, 2, 3 years, then short-term bond funds might be suitable. Liquid funds again, anywhere up to a few weeks to up to a year, right? Um, if you look at just the volatility itself, right? So the arbitrage fund, it's kind of close to 1%, right? Like 0.9%. And this is where liquid funds purpose, or like we can think like how to clearly differentiate, right? Because both are giving you similar returns, then which one should I buy? Like you're stuck between arbitrage funds and liquid funds. So how to differentiate, right? So we know that the underlying securities, like underlying holdings, are completely different, right? That is clear. But the volatility itself, it's liquid funds are like almost like what, 4 times, 5x lower, like in terms of volatility, right? So this gives you stable returns with significantly lower volatility, right? So if you are looking for the safest instrument between like arbitrage funds and liquid funds are like much in terms of volatility, that just speaks volumes, right? And also in terms of drawdowns, uh, again much lower, right? 0.17 versus 0.65% here, whereas like short-term bond funds, understandably so, your holding period for a short-term bond fund is not few weeks, or like few months, right? Your holding period is anywhere north of 1 year, 2 years, right? And same for like the overnight funds, right? Your holding period, like it's probably a few days to a few weeks, right? And it's the lowest, like lowest among all these categories. So now we understand like clearly how these funds are different and which fund is used for like what purposes, right? Now let's again like look into the performance graph itself, right? So I just want to know, I like to replicate things. So let's do some sort of like a replication exercise in this video. So we can see the arbitrage fund, it's kind of in between short-term bond fund and overnight fund, right? So in the dashboard I kind of created a portfolio comprising of short-term bond fund, like I've allocated 50% to like same short-term SPI that we saw, and the overnight fund, again 50% allocated to it, right? So I'll quickly add this fund, and let's see just for an exercise, right? How this portfolio looks. Because like arbitrage funds, like I think you are paying almost what 0.42, 42% here, right? So when you combine short-term bond funds and SBI, like that is the overnight overnight, like you're not looking to like increase or decrease the expense ratio, right? Although that was my goal initially, but just in terms of like pure excise and like pure performance wise, right? If you look at it's again superbly close to the SBI liquid fund and mainly the arbitrage funds, right? Like in terms of the performance itself, right? Because now you're comparing these two. Because like the arbitrage fund itself is in between short term and the overnight funds, right? Now, this brings us to the end of the video and thinking about who should choose which fund, right? So mainly the competition here is between the liquid fund and the arbitrage funds because they both behave the same way. The returns are not exactly the same. They are similar because of the linkage that I mentioned, right? The link to the interest rates. So they will always, uh, I think we can say with good confidence that they will always be similar or closer to each other with few basis points away. Um, so which fund should be chosen for, which fund should you choose? So I think the simple kind of framework for this would also would boils down to your tax bracket, that is your income tax where do you fall in the income tax bracket, as well as I mean holding period. I will just assume the holding period is less than a year, because if you want to hold this for like let's say 2 3 years, it begs the question, why not just go for a short term bond fund, because the returns are significant, not significantly, but a percent, 1% to 1.5% higher than liquid fund, right? So assuming that your holding period is less than a year to a few months or weeks, right? Which fund should one consider? So I'll start from the highest tax bracket, right? So let's say you're in the 30% tax bracket. So as per the latest 2024 tax regime, right? So for equity funds, if you're holding it for less than 1 year, which is short-term capital gains, and more than 1 year is long-term capital gains, right? So if you are going to sell it before 1 year, it's considered as short-term capital gains, and for that, the tax, that is the percentage, that is the when you're going to sell, right, the percentage that you're gonna pay in terms of like the taxation rate is 20%, whereas for the long-term capital gains, if you sell it after a year, it is 12.5%, right? So let's just focus on the short-term capital gains, because we are assuming that your holding period is less than 1 year, right? That's the purpose of these kind of two funds, right? So for debt funds, that is the funds like liquid funds, right? The taxation itself for debt funds is similar to like whatever slab rate, like the income tax slab rate, right? So if you're in the 30% slab rate, then your taxation on the liquid funds itself is 30%, right? So for people for investors in the highest tax rate, that is 30%, arbitrage funds make a lot of sense because you're in terms of taxation, you're going to pay for short-term capital gains. You're going to pay only 20%, right? That is, it comes under the equity taxation, right? Whereas for liquid funds, since it's similar to your income tax slab, you're going to pay 30%. So for 30% for 30% tax slab rate people, I think arbitrage fund makes sense. Uh, for investors falling between 20%, 10%, I think you can make case for like for 10%. I think for sure liquid funds kind of makes sense because you're going to be taxed at 10% compared to 20% for arbitrage funds, right? Because short-term capital gains for equity funds are 20%, right? For 10% slab rate, for sure liquid funds make sense. Um, People in the middle, that is the 20%. I mean, depending on the returns, right? The returns are not exactly the same all the years. Sometimes arbitrage funds may give you a few basis points more. Sometimes liquid funds may give you few basis points more, right? So people in the middle, I think, let's assume that both the returns are the same. You can choose either of them, right? So I think that sums up the entire video, right? Arbitrage funds, nothing magical about it. It's not like, I mean, you can call it as an equity fund. It doesn't behave as an equity fund. It's not as risky, right? No, we've also replicated the arbitrage fund using short-term bond fund and overnight fund, and it is exactly like similar in terms of returns, right? And it will also always be similar to a liquid fund. I think that's the end of the video. Thanks for watching. See you next time.